Brazil's central bank bars digital assets. From some cross-border rails, the Banco Central do Brasil (BCB) has banned the use of digital assets in parts of the country's regulated cross-border payment and transfer infrastructure, according to an announcement carried by CoinMarketCap on May 1, 2026. The restriction targets licensed payment institutions that handle international transfers, not retail self-custody activity. The move tightens a framework Brazilian regulators have been drafting since the 2022 crypto law assigned the BCB primary authority over virtual asset service providers. It also lands at a moment of broader macro tension. BTC is trading at $78,701, up 3.1% in 24 hours, and the Crypto Fear and Greed Index sits at 45 neutral as of May 1, 2026, per CoinMarketCap data. What the BCB restricted per the disclosure, regulated cross-border payment, and transfer services may no longer use digital assets as an internal settlement leg for certain operations. The cited examples cover services where a Brazilian payer or receiver interacts with a licensed institution that previously routed value through stablecoins or other tokens before converting to fiat at the destination. The BCB has not banned crypto outright. Self-custodied transfers between private wallets, peer-to-peer trades on Brazilian exchanges, and crypto-to-fiat conversions on registered VASPs remain legal. The line being drawn is narrow. A licensed cross-border payment operator cannot use a digital asset as the bridge currency inside its regulated workflow. Why stablecoins, where the real target Brazilian importers and freelancers have leaned on USDT and USDC to move dollars in and out of the country faster and cheaper than SWIFT or correspondent banks. Several local fintechs built operations on top of that flow, settling client orders in stablecoins behind the scenes and presenting customers with a fiat-only interface. Reuters and Brazilian outlet Valor have previously reported BCB concerns that this hybrid model bypassed FX controls and complicated anti-money laundering oversight. The new restriction directly addresses that gap by forcing licensed operators back onto traditional rails, or to a future tokenization framework the BCB controls, the Drex CBDC and tokenized real ecosystem. Implications for Brazilian card users and remitters. The most immediate effect is on Brazilian users who relied on hybrid fintechs for cheap dollar access. Operators that promise low-cost USD transfers funded by stablecoin flows will need to either restructure or operate outside the regulated perimeter, which carries enforcement risk. For Brazil-based crypto card holders, the impact is indirect but real. Cards that load BRL via crypto sales on a domestic exchange are not affected. Cards that rely on a foreign issuer routing stablecoin balances into local PIX payouts could see their pricing or speed degrade if those rails fall under the new rule. Users should expect issuers to clarify which products remain compliant in the coming weeks. The broader message is that Brazil now sits closer to the US Treasury and EU posture. Stablecoins can exist, but their use inside licensed payment infrastructure will be channeled through tokenization frameworks. Regulators control rather than open USDC and USDT flows. Cards that emphasize stablecoin spending or zero foreign exchange markup for Brazilian residents will need to document how their settlement legs work. How this compares to other jurisdictions, Brazil joins a short list of major economies that have explicitly carved digital assets out of regulated cross-border services rather than letting them coexist. The closest parallel is the EU's MyKA-aligned guidance to payment institutions that token settlement legs require separate authorization. The US has moved in the opposite direction recently, with proposed stablecoin legislation that would formalize tokenized dollars inside the regulated payment perimeter. The contrast matters because Brazil has positioned itself as a regional crypto leader, with high retail adoption, a domestic ETF market, and an active tokenization pilot. A restrictive rule on cross-border crypto payments coming from the same regulator that has championed Drex signals a clear preference: state-controlled tokenization in, open network stablecoins out, at least within licensed channels.